Hello everyone. So as you are seeing on my screen, so today's topic is EBITDA or simply EBITDA. So without wasting time, let's get started. So what is the full form of EBITDA? It's earning before interest, tax, depreciation, and amortization. It's a financial metrics used to evaluate company's operating performance. So basically, as we can understand, these are the financial terms like interest, taxes, depreciation, amortization. So all are shown in the financial statements, and this is just to basically understand how it is calculated and what are the uses of that we will discuss. So, EBITDA is not anywhere. I mean, anywhere it is recognized as a US GAAP or maybe IFRS, but still it is very much and commonly used in management accounting. So if you are one who are preparing reports, then you must be heard this EBITDA. Or maybe you in a corporate culture, you might have came across in many of the corporate meetings this word as a EBITDA. So earning, we know that what's the earnings. Interest is if we have borrowed some amount, we have to pay the interest for that. And taxes, as we know, depreciation is suppose if we are using some fixed assets like a building or uh, vehicles, machinery. So for that, it is used as a depreciation. So with the period, it is get depreciated. So we have to write off those amounts. So it is a kind of expense, but it is not monetary expense. And same way for amortization. For example, if we have purchased a running business and we might have paid a goodwill. So for that goodwill, we need to it's our asset and we need have to amortize that over a period of time. So as I have told you how it is calculated, so it is calculated as a profit. Since profit is calculated after deducting the depreciation and amortization, so we have to add back those to in the operating profit, then we will get EBITDA. Let's understand one these things with one example so that we can get a better idea. Let me open it this in Excel. Yeah, here we go. So, so this is our revenue. So if we deduct this cost of goods sold, basically cost of goods sold is cost of material and some labor, direct labor and overhead. So this is all included in the cost of goods sold. So basically, if we deduct all the direct expenses, then we will get a gross profit. And there are also some operating expenses. Operating expenses are those expenses for which are required for running, for example, rent, salaries for the employees, some other like uh, office expenses and all those. Those are included in operating expenses. So if we deduct this, then we will get EBITDA. So this is kind of because of this is EBITDA. So, but net income. So in the income statement, you might have seen this is a income statement. Up to here, it's a income statement. So here, if you see, and these expenses like depreciation, amortization, interest, and taxes are deducted, then we will get that this net income. Now, if we have only net income and the other expenses, I mean, non-monetary expenses like depreciation, amortization, interest is of course a monetary expense, and this is also like cash outflow we will see these two. But these two is just shown the books. So if we add these four in our income, net income, then we'll get this EBITDA. So in this way, it's calculated. Let's go back to the presentation. Yeah. So now we have understood that how it is calculated. Now it is better for us to so see the importance for the EBITDA, how crucial it is. So this is basically meant useful for seeing the operating profitability. For example, if we are suppose uh, uh, check the operating capability of the manufacturing or any entity, then we can compare it. Because as I have informed earlier, like interest payment and taxes and depreciation are not included. So it is basically a clear cut indication of the performance operations of the business. So it is the same thing which I have informed you. So it is useful for accounting decisions, and EBITDA margin is also useful. For example, if I even go back to the Excel, then if I calculate here, suppose this is our EBITDA 350K. So this 350K, if I divide it by the revenue, then this percentage which we get is 35%. So in this case, so this is basically the EBITDA percent. So this higher percentage means, of course, we are saving these costs. So it is very useful. And for comparison purpose also, it is very useful that how profitable the business is. For example, if we compare with the same industry of another segment or maybe another entity, then uh, it is comparable number. And the higher it is number, the better the business it is. So as I inform you that it is useful for the comparison. Now, in most of the businesses for valuation also this method is used. So EBITDA is used for the whenever the business will maybe put on sale or maybe the prospective buyers, potential buyers can use this number as a for the basic like for valuation. And this is a kind of assessing the cash flow. It is act as a proxy for the cash flow. It helps in evaluating the company's ability to generate cash flow from its core operations, and especially when the net profit is not reported or when the uh, assessing cash flow across the industry. So, and for this purpose, it is very useful. And this is independent of capital structure. So this is very important point again. So for suppose if we take example of one company which is there is high debt in that company. Another company has higher equity. So in this case, so for example, the company with higher debt would be having very huge amount of interest for this huge amount of interest. Well, the company which is equity component higher, in this case the interest amount would be lower. Here it will be high. So if we check the net income of these, even if both the companies are performing similar, but still here the net income would be lower, and here the net income would be higher. So in such case, you should not compare it with the net income to net income. Here we will compare EBITDA to EBITDA. So here it's very useful, as here it's mentioned. I will save this file in the description so that you can go through this file. So yeah, of course, as I informed earlier, this is not anywhere mentioned in US GAAP or IFRS. So it should be used cautiously. And Warren Buffett and other also criticize this, and it does not affect. It does not take into consideration the depreciation. Depreciation is very useful. For example, if we have purchased a huge asset, then for example, its useful life is 5 years, and we are not considering that depreciation here. Suppose if you bu- bought an asset of, let's say, machinery of 100K, and in that case, if we divide it by 5 years, then every year the depreciation would be 20K, right? 20K is our expense, which is not considered here. So that's why uh, this EBITDA is it is one of the limitations of EBITDA. Yeah, for the summarize, we can say that it's kind of proxy for cash flow from company's operation. It focuses on operating decisions, and as I informed, we should be cautious while using this US GAAP. So this was the simple understanding of IFRS, sorry, EBITDA, and let me know in the comment what next thing you want to learn. Okay, thank you for listening to me, and please subscribe to my channel, like if you wish. Thank you so much.